Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, Wall Street kicked off November, historically the best month for stocks, with a burst of optimism as technology titans fueled yet another leg of the artificial intelligence rally. Amazon.com Inc. surged 4% after unveiling a $38 billion 7-year partnership with OpenAI, which will pay Amazon Web Services for access to hundreds of thousands of NVIDIA graphics processors. The deal placed Amazon firmly in the AI infrastructure race and sent the Magnificent Seven mega-cap index up 1.2%. Despite that strength, more than 300 S&P 500 members declined, hinting at narrowing market breadth. Bond yields ticked higher, the 10-year Treasury rising 2 basis points to 4.1%, while Bitcoin slipped 3%. Analysts still see seasonal tailwinds at work. Quote, "This bull market has room to run," end quote, said an analyst with UBS Global Wealth Management, even as others warned that too many bulls could make stocks vulnerable to shocks. History, for what it's worth, remains on investors' sides. Since 1928, when the S&P 500 has gained 10% or more through October, November averages a further 2.6% rise. Third quarter earnings have handily beaten expectations, with profits up nearly 13%, one of the strongest seasons in years. Tech and healthcare led the charge as AI enthusiasm kept sentiment buoyant. Traders remain hopeful that easing inflation, resilient earnings, and the prospect of a December Fed rate cut will extend the rally through year-end. Yet outside Wall Street's glow, the real economy is reeling from Washington's paralysis. The federal government's shutdown, now a month old, is the longest since the 35-day record of 2019 and is biting hard. Food stamp aid for 42 million Americans has been disrupted despite court orders. States from New York to Maryland are scrambling to fill the gap. Obamacare premium subsidies have expired, doubling costs for 20 million enrollees, while 35,000 children risk losing access to Head Start programs. Air travel has slowed as unpaid controllers call in sick, prompting Vice President J.D. Vance to warn of holiday chaos. Hundreds of thousands of federal workers remain furloughed or unpaid, and the Congressional Budget Office estimates $18 billion in lost output so far. Both parties blame the other. Republicans demand passage of a short-term funding bill stripped of health care subsidies. Democrats insist on renewing them. As the standoff drags on, business leaders and unions alike plead for action. The longer the shutdown persists, warns the U.S. Chamber of Commerce, quote, "the larger and more durable the economic damage becomes, and some of it may never be recovered," end quote. Next up, we move quickly to Asia now. The Philippines and United Arab Emirates, UAE, have formally applied to join the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or CPTPP, a 12-member trade bloc increasingly seen as a bastion of free trade amid rising global protectionism. According to Japanese government sources, speaking to Japan-based financial media outlet Nikkei Asia, both nations submitted their applications to New Zealand, the CPTPP's administrative hub, in August, marking the first new bids since Indonesia's in September 2024. The CPTPP, previously known as the Trans-Pacific Partnership, or TPP, eliminates tariffs on a broad range of goods and standardizes rules on intellectual property and trade practices across its members. Vietnam, Singapore, Brunei, Malaysia, Australia, New Zealand, Japan, Canada, Mexico, Peru, Chile, and the United Kingdom. Costa Rica is currently in accession talks, while China, Taiwan, Ecuador, Uruguay, and Indonesia have also applied. For Manila, joining the CPTPP represents a strategic effort to secure economic resilience as global trade fractures. Quote, "The strategic move is critical for securing the nation's economic future," end quote, said the Philippines Chamber of Commerce and Industry, noting the pact's potential to counter the effects of past U.S. tariffs. The Philippines has already deepened trade talks with Japan through an economic partnership and a reciprocal troop access agreement that underscores their growing diplomatic closeness. Considering that the Japanese occupied the Philippines during World War II, this is quite the breakthrough in relations. The UAE, meanwhile, is the first Middle Eastern nation to seek CPTPP membership, Its application aligns with its ambitious economic reform agenda to diversify beyond oil dependence. The UAE recently implemented trade deals with Australia and Malaysia and is negotiating one with Japan to further boost investment and trade. Accession talks require unanimous consent among current members, with decisions likely discussed at the next ministerial meeting later this year. If successful, the expansion could strengthen the CPTPP's role as a cornerstone of open trade, currently representing about 15% of global GDP. The issue, however, is that many of these countries are net exporters, meaning they seek big markets to sell to. Within the bloc, there is only a small number of countries with relatively high consumption shares of GDP. These are basically the Anglophone countries, the UK, Australia, and New Zealand. So while this bloc can provide some alternative to markets that previously sold to the US before tariffs were introduced, the US and its market still remains the most lucrative game in town. Next up, we have one more development to cover, but just quickly, if you want to continue to be on top of the biggest developments in the world's most important markets, consider subscribing to Market Update. And if you're getting some value from today's episode, it's a huge help too if you can just hit that like button. And finally for today, labour migration to advanced economies dropped sharply last year as weaker job markets and tougher visa restrictions curtailed inflows, according to new data from the Organisation for Economic Cooperation and Development, OECD. The Paris-based organisation reported that permanent work-related migration to its member states fell by 21% between 2023 and 2024, reaching 934,000. The decline came even before Donald Trump's return to the White House, which is expected to further limit inflows to the United States. A significant driver of the fall was the UK, where net immigration declined by more than 40% from 2023, following a series of government crackdowns on student and worker visas. Yet, even without policy changes, even European countries saw labour migration drop below pre-pandemic levels. Germany and the Netherlands, both of which had recorded historically high inflows in recent years, experienced marked declines. The head of the OECD's International Migration Division said the slowdown reflected a quote, less favourable, end quote, economic environment and the ongoing presence of Ukrainian refugees across Europe. Many of these refugees, he noted, had, quote, helped to reduce the pressure, end quote, in industries with chronic labour shortages, such as construction, which hire men, and care work, which hire women. The OECD also found that international student migration, another major channel of labour mobility, fell sharply. The number of new international students declined by 13% between 2023 and 2024, following visa tightening in the four largest Anglophone destinations, the US, UK, Canada, and Australia. Policymakers in these countries have acted to curb visa fraud and ease pressure on housing markets, where student demand has exacerbated shortages. Despite the slowdown in work and study migration, overall permanent migration to OECD countries declined by just 4% in 2024 to 6.2 million. So-called humanitarian and family migration continued to rise, supported by a surge in asylum applications to the US late in Joe Biden's presidency, and an increase in illegal small boat arrivals to the UK, a source of political tension in the country. It will no doubt be frustrating to folks in the UK to hear that skilled migration is down while illegal migration is up. Total migration remains about 15% higher than pre-pandemic levels. Temporary labour migration, which covers workers without a path to settlement, remained steady at 2.3 million across the OECD, 26% above 2019 and 51% higher than in 2015. Management of immigration and migration patterns across many European economies will continue to be a key factor in voting patterns and as such downstream policy implementation in the coming years. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday and I hope to see you for the next episode tomorrow.